Good morning and welcome to Nasdaq's IR Insight Live. I'm Tamar Essner and I'm joined by Masoud Ghazi, who is a senior analyst in our Nasdaq IR Solutions business, for a conversation about the capital markets. Masoud, thanks for joining.
Nice chatting you, Tamar.
Okay, so lots going on in the dog days of summer, a lot of news flow. Investors might not be paying attention. What's the latest on what people need to know about?
Yeah, so it's interesting. Last year we were talking about synchronized global growth. That has been replaced by emerging market trading fears and also trade fears across the world. If we look at the JP Morgan Volatility Index, it has spiked on the heels of the fallout in Turkey. Emerging market bonds, stocks, and currencies are exhibiting pretty aggressive volatility. And the fear here is that the global contagion may affect developed markets.
So I've heard that there's been some cooling off in some of the data coming out of those developed markets. What's the latest there, and does it have the potential to impact us in the U.S.?
Yeah, so to your point, overnight we saw in China macroeconomic numbers cooling off. Also, over the last 2-3 weeks in the United States, we saw the U.S. PMI services, manufacturing index, agriculture index, all slightly cooling off. They're still at heightened levels. So I wouldn't be too concerned, but trade war fears have definitely affected some of the numbers coming out of the United States.
So moving from the equity conversation more to the debt side, we see that the Treasury yield curve has flattened. Some people have even talked about the potential to have an inverted yield curve, which typically would signal a recession. What do you think it signals?
Yeah, so to your point, there is a lot of competing theories out there. The one that I think is most viable and has explanatory power is that in a globalized world, awash with a lot of capital because of loose monetary policy over the last 10 years, investors are hungry for yield. So despite the fact that the Fed is increasing rates, and this pushes up the short-term yields, there's a lid on long-term yields. And when you look at Europe, when you look at Japan, and long-term yields are generating 0 to negative, it's only natural that investors move to the United States and park their capital in long-term Treasury yields that are generating 3% yield. And mind you that the world of government bond yields is a relative market.
So you mentioned a lot of data and statistics. What's the latest on sentiment? We're about to enter, we are in our 10th year of this bull market run in the U.S. Do people think it has legs? Are they skittish about it? What are people talking about? What are they saying?
Well, overnight we saw the Bank of America Merrill Lynch investor survey come out. This is mostly U.S.-centric, but looks like as though there's a lot of bullishness in the U.S. markets. They interviewed 250 investors representing approximately $750 billion assets under management, and they're all, in aggregate, they're moving about from 10% to 19% in terms of allocation, and This is the biggest move in 5 years.
So they're still bullish?
I would like to think so, yes,
so
as per the numbers.
10th year, potentially 11th year?
Yes.
Masoud Ghazi said it here. Thanks for joining, everyone. That was Masoud Ghazi. For more insights from Masoud and his team, please check out our website at business.nasdaq.com. If not, we'll see you next time. Thanks for joining.